In today's video, we'll be exploring the world of bubbles in the stock market and the housing market, as the S&P 500, the largest stock market index around the world, has just been rejected at a very key trend line that has held as significant resistance on multiple occasions in the previous few years. We'll also be having a look at the largest tech stock index around the world, which is the NASDAQ, as it too has been rejected at this time an even longer term trend line dating back all the way into the 1990s. Now, in today's video, we'll be analysing what has caused these huge bubbles and whether we expect the crash to continue, or whether our good friends at the central banks and Federal Reserve will once again step in and announce unlimited amounts of money printing, in further committing to devaluing fiat currencies to keep this Ponzi scheme of a stock market and financial system bubble afloat.
Can you characterize everything that the Fed has done this past week as essentially flooding the system with money?
Yes, exactly.
And there's no end to your ability to do that?
There is no end to our ability to do that. And there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
I believe that in a world where central bankers are tripping over themselves to devalue their currency, Bitcoin wins. In the world of fiat currencies, Bitcoin is the victor, Brian.
Okay guys, today's going to be one of the most important videos we do on this channel, so strap yourselves in. We'll firstly be analysing this huge stock market bubble with the craziest valuations we've ever seen. We'll be analysing whether this 30-year secular bull market in not only the stock market but also the housing market is likely to continue. Because with the highest debt levels that we've ever seen in 7,000 years of monetary history, and with interest rates at zero and even negative around the world, central bankers and big governments are actually unsure what to do with the bubble that they've created. They're so unsure they've had to create a new branch of economics called modern monetary theory. So in this video, we'll be exploring what MMT is and how it's going to affect not only the housing market and the stock market, but what impact it will have on asset classes around the world, but also the purchasing power and the value of the money that you hold in the bank. But not only that, also the value of your parents and your grandparents' superannuation funds, because they may not be as safe as originally thought when MMT kicks in. Okay, so today's video is going to be a very, very important one to wrap our heads around, okay, guys? Because we are currently in the most uncharted, unprecedented economic conditions we have ever been in all time, okay? I just done a video the other day where we had a look at the recent correction or crash in stock markets that have crashed 6 to 7% over the past few days. And I've actually had a lot of people ask me, oh, should I get into the stock market now? Should I start to buy some stocks? And because they say, oh, stocks only ever go up, okay? Stocks have only ever gone up for as long as we've remembered. But we've got to remember, guys, like the stock market and any paper assets are more overvalued than they've ever been in human history, okay? Things don't continue to just keep going up and up and up. Okay, you go through these transitions, and that's what this video is going to be about. We're going to be analysing just the massive bubble in debt, the housing market, the stock markets, valuations in the stock market. They've all never been higher, okay, guys? So this here is deflation assets. This is anything that is an asset that's tied up to someone else's liability. So it's built on debt. So this is the housing market, this is the stock market. As you can see, more overvalued in comparison to the inflation assets, so this here is yellow, than all time, guys, okay? Paper assets have never been more overvalued when compared to gold or silver or commodities. That's our inflation assets, guys. That's just one little example. Let's have a look at the stock market price to sales. Also, record high. Any metric that you use to analyze the stock market, it is at an absolute extreme all-time high. And as we're about to see further into the video, this is all about to change, okay? There's been a time and a place to own stocks and to own houses as an investment, and that time has been over the previous 30 to 40 years, okay? That the best time has to own those assets has been while we've been continually lowering interest rates, okay? So as the Ponzi scheme grows and the debt bubble just explodes, which we touched on in that Bitcoin super cycle video, we gave a 5-minute intro to the entire global financial system. If you haven't seen that, go and watch it. I'm going to pop it up on screen right now, somewhere around on the screen. Go and watch that one. We give a very brief overview of how we've accumulated the $300 trillion in debt. But as you can see, this constant lowering of interest rates for the previous 30 years has meant it's been a great time to invest in any asset that's related to debt or tied to debt, such as the housing market and the stock market. It's been a great time to buy. It's been the biggest bubble bond market. Been a great time to buy because the price of bonds has gone up as the interest rates have lowered. But now you get into a stage where you normally see these kind of transitions or these shifts, guys, where this amount of debt is currently unsustainable and it has to be deleveraged in one way or another. And that's all got to do with the long-term debt cycle, which we're also going to touch on later on in this video, and how when we reach similar levels of debt here back in the 1930s and 40s, that debt needs to be dealt with, and generally it's devaluing the currency is how we're going to deal with that debt. But we're going to touch on that one later and analyze the 80-year long-term debt cycle in much more detail. But in today's, we're just giving a short little look at how crazy some of these valuations are in the stock market. This is not normal, and this is not the best time to be investing in any kind of stocks. So this is the market cap of the stock market related to GDP. Also, record high, 187%. Okay, that's never been achieved before. Stocks have never been that overvalued. Here's another a great chart. We've got corporate equities and the profits. And as you can see here, since 2010, the corporate profits have actually declined. They haven't gone up at all. So why have the valuations? So this is the blue line, the corporate equity value. Why have valuations just continually skyrocketed? Okay, guys, why have the price of these companies and stocks continually gone up and up and up when they haven't been making any money? Their profits are sideways, if not stagnant, since 2008. That's all got to do with the massive amounts of debt and corporate stock buybacks. Now, our good friends at the Federal Reserve changed the law, as you can see, about 15 to 20 years ago now, enabling these huge mega companies to buy back their own stock. Now, all that means is they're able to go and get massive loans from their good friends at the central banks and the largest banks around the world at nearly 0% interest rate, and they take that newly loaned money and they simply buy back shares in their own company. Okay, so they're not making any more money, or they're just giving the people the illusion that the stock market is booming. And as you can see by this blue chart, corporate buybacks have absolutely exploded since the 2000 tech bubble burst, okay? Because the central bankers needed the illusion that the stock market was doing well and everything was healthy and hunky-dory because they weren't ready for the next financial system to be implemented, guys. We'll get to that one in just a sec. But as you can see, all these corporate buybacks, so these companies buying back shares in their own companies and taking on these huge amounts of debt has led to over 20% of the S&P 500 companies being a zombie company. Now, a zombie company just means that company is not profitable and it's unable to pay back the principal of the loans that it currently has. So you have a principal and an interest portion of a loan. Now, these companies are unable to actually pay back any of the debt. They're only able to remain open and remain profitable because the central bankers, whenever there's a crash, they swoop in and they save the stock markets, as you can see here. Wherever there's a crash and these unprofitable companies are about to go bankrupt, the central banks swoop in and buy up their shitty debt in the corporate buybacks, okay, guys? And they're also able to go and get these They're also able and go and get loans at nearly 0% interest rate to keep this bubble going. Now, why do central banks and big governments seem intent on blowing up these bubbles even further? Because their portfolios are mainly stock market and the housing market heavy, okay, guys? That's what they own. The top 5% of richest people, they own 70% of the stock market worldwide, guys. That's the game. That's why the wealth inequality keeps getting wider and wider, which we're going to touch on in the part 2 of this video. Because every time stocks crash towards their fair value, central bankers step in. And as you can see right now, this is a live feed of the US debt clock. They are printing $1 million every 18 seconds to keep this Ponzi scheme alive. Because, as you can see, when the Ponzi scheme of a financial system collapsed in 2008, they weren't ready for the new system to be implemented. Okay, guys, as you can see, central banks weren't buying gold for the previous 50 years, ever since we've been on this financial experiment where every country around the world is using a fiat currency. Yes, I'm going to touch on that one in every single video because this is the largest financial experiment of all time. And as you can see, when it was apparent to the central bankers that this Ponzi scheme was about to collapse in the 2008 GFC, central bankers have bought more gold than they have every year than the previous 50 years combined, getting ready for the new financial system to be implemented. I reckon the central banks have got enough gold now. As you can see, for the previous 10 years, they've been loading up. They're ready for the new system. But we're going to touch on that one in part 2 of this video because once again, I'm sorry guys, we have ran out of time for part 1. I'm trying to keep these videos relatively short. In part 2, we're going to be going into much more detail about all the bubbles in the housing market as well as the stock market. We're going to be having a look at some technical analysis on the chart to see whether this S&P 500 has just been rejected on a very key trend line. We're also going to be pricing the stock markets in gold and showing why they look very different when you price the stock markets in a gold, a form of money that's not changing, opposed to a form of money that is having its supply increase exponentially. That's the dollars that we use as money, guys. But a little bit of housekeeping, you know how we roll. We've got to try and play that YouTube algorithms game. So if you've liked anything or you want to support the channel or you just want notifications for when I put my next video up, hit the like button down below, hit the subscribe button. It really helps the channel grow, guys, and put this content in front of more and more eyes on YouTube. So stay tuned for part 2. I'll see you guys shortly.